the community. We're delighted to welcome Harris & Co today, who, as well as being our auditors, have got lots of experience in working with charities of all different sizes. Today's session will cover the changes in the Charities SORP 2026 and some of the practical implications of those changes. So I'll now hand over to Phil Harris, who's CEO of Harris & Co, and he'll take you through the update, and then there'll be some time for questions at the end. Over to you, Phil.
Thank you, Jenny. So thank you for inviting us to speak with you today. The purpose of this session is to explain recent and forthcoming changes affecting charity audits and financial reporting, and crucially, what they mean in practice for charities like yours. Charities are operating in an environment of increased scrutiny, tighter funding, and higher governance expectations. In response, the regulatory framework for charities continues to evolve, with changes designed to improve transparency, consistency, and public confidence. So why do these changes matter? The changes we will discuss today are not simply technical accounting updates. They affect whether your charity requires an audit or an independent examination, the cost, scope, and complexity of your annual accounts, the responsibilities of trustees, particularly around risk, reserves, and financial sustainability, and how your charity's activities and impact are communicated to funders, beneficiaries, and regulators. In particular, regulators such as the Charity Commission are increasingly focused on clear financial reporting, robust governance, and trustees understanding, not delegating, their financial responsibilities. This session is really for trustees, finance staff, senior managers, and anyone involved in charity governance or financial oversight. You'll be very pleased to know that no prior technical accounting knowledge is assumed. What hopefully you will take away from today's session is understanding whether your charity needs an audit or an independent examination. Be aware of what has changed in the new Charities SORP. Understand the practical impact on trustees and finance teams, and know what actions to take to remain compliant and well governed. So a good start point for this process is to understand which law applies to your charity. A charity can fall under either the Charities Audit Regime, the Companies Act audit regime, or possibly both. And the key differences relate to which thresholds apply, who sets the rules, and what type of assurance is legally required. The Charities Act 2011 for England and Wales applies to all registered charities, incorporated or unincorporated. It sets audit thresholds based on charity income and/or charity income and assets. It allows independent examination instead of audit for many charities below the audit threshold. The Companies Act 2006 applies to charitable companies, in other words, charities incorporated as companies. It uses company size criteria, which are turnover, assets, and employee numbers, to determine whether a statutory company audit is required. A charitable company that qualifies as a small company and stays below the Companies Act audit thresholds may elect out of a Companies Act audit. There are significant differences between the Charities Act audit thresholds and the Companies Act audit thresholds. A charity must have a Charities Act audit if its income exceeds the Charities Act audit threshold, or its gross assets exceed the Charities Act asset threshold and income exceeds a certain limit. The exact thresholds change over time, and the Charity Commission guidance outlines the current values, of course, at what the current thresholds are and some anticipated changes. The Companies Act audit thresholds are different. A charitable company must have a Companies Act audit if it exceeds 2 of the 3 small company limits, which are a combination of turnover, balance sheet total, and employee numbers. If it stays below these limits, as I mentioned earlier, it may claim audit exemption under the Companies Act. The type of assurance required differs under the 2 acts. Under the Charities Act, if the charity is below the Charities Act audit threshold, a charity may choose an independent examination, which is a lower cost, lower assurance alternative to audit. If above the threshold, a Charities Act audit is required. Under the Companies Act, if the charity is above the Companies Act audit threshold, a full Companies Act audit is mandatory. If below the threshold, the charity may opt out of a Companies Act audit and instead have a Charities Act audit or a Charities Act independent examination if eligible. Under the Charities Act, the audit report must comply with the Charities Act 2011 requirements. Additional charity-specific reporting duties apply, for example, reporting on whether proper accounting records have been kept and whether the accounts comply with the charity's SORP. Charity audit reports differ because of these distinct legal and regulatory requirements. Under the Companies Act audit, the audit must comply with the 2006 Act and other UK company law. It focuses on company law requirements rather than on charity-specific matters. Potentially, both regimes could apply. A charitable company may qualify for audit exemption under the Companies Act, but still require a Charities Act audit if it exceeds the Charities Act thresholds. A charitable company may qualify for audit exemption under both acts and therefore choose an independent examination. Or a charity may exceed the Companies Act thresholds and therefore require a Companies Act audit which satisfies the Charities Act requirements. A common question we get is, what if I exceed the audit thresholds for both the Charities Act and the Companies Act? In this instance, the audit is performed solely under the Companies Act. So, new Charities Act audit and independent examination thresholds. Some thresholds differ depending on whether a charity is a charitable company or an unincorporated charity. There are some expected changes to the Charities Act from the 1st of October to 2026. The audit threshold based on income is expected to increase from the current 1 million to 1.5 million. The alternative audit threshold, which is a combination of income and assets, increases from the current 3.26 million to 5 million if income is above 500,000. The independent examination threshold is expected to rise from 25,000 to 40,000. And for the accruals accounts threshold for unincorporated charities, this is expected to rise from 250,000 to 500,000. This has practical consequences if these changes go through. Some charities may see reduced costs, others may face new governance and compliance requirements, and trustees must be alert to future growth, pushing them over the thresholds. For the Companies Act thresholds, changes have already come in for financial years beginning on or after the 6th of April 2025. Charitable companies are now audit exempt if they meet 2 of 3 thresholds. The first threshold is annual turnover, which is no more than 15 million, previously was 10.2 million. Total assets of no more than 7.5 million, previously was 5.1 million. And the number of employees is 50 or fewer, and that test hasn't changed. Oops, sorry. I've messed that up. What is not changing is registration with the Charity Commission. That's still required for income over 5,000. Annual return submission is still required if income is over 10,000. And the accounts filing must still be made with the Commission if income exceeds 25,000. So there are some practical impacts on charities. Charities unknowingly may remain in audit when no longer required. Charities may breach the new thresholds without realising until later in the year. And there's often confusion over gross income versus net income, one-off grants, and group income across multiple entities. Trustees remain fully responsible for the accuracy and integrity of accounts. Independent examination is not a lighter version of audit, but a different form of assurance. Trustees must still ensure proper accounting records are kept, and understanding the thresholds is therefore a governance issue, not just a finance one. So I thought I'd just give you a couple of examples of the possible impact on the new thresholds. And these are not on the fully on the screen just yet, but I will go through them. So the first example is moving from audit to independent examination. So a grant-funded community charity currently has an annual income of £820,000. Historically, it has always had an audit because it always has. Under the revised thresholds, an audit is no longer required. The key lessons for trustees are an audit is not mandatory simply because it was required in the past. Trustees may choose to retain an audit voluntarily, but should understand why. Independent examination can reduce cost, but does not remove the trustee's responsibility. In my second example, we're looking at an unexpected move into audit. So here we have a service delivery charity that normally has an income of around £900,000. In the year, it receives a one-off grant of £700,000, pushing income above the audit threshold. Some key lessons for trustees are thresholds are based on gross income, not normal income. One-off grants can trigger an audit unexpectedly, and trustees should monitor income during the year, not just at the year end. My third example is around the group income trap. So a parent charity has income of £900,000 and a trading subsidiary has an income of £700,000. Individually, neither entity breaches audit thresholds, but together they do. So key lessons for trustees are group income can matter. Trustees must understand the structure, not just the headline figures, and early professional advice can avoid last-minute compliance issues. And my final example is around independent examination. Independent examination is lighter, but it isn't light. Trustees often assume that independent examination means fewer questions. However, the independent examiner still needs to review the accounting records, still needs to ensure compliance with a charity SORP, ensure consistency between narrative and the figures in the accounts, and poor records or weak governance will still be identified. So hopefully some of those changes to thresholds and requirement for audit will help in understanding the applicability of the new Charities SORP. So I will now turn to the Charities SORP. So the Charities SORP 2026 sets out how charities should prepare their accounts and trustees' annual report. It interprets UK accounting standards for the charity sector. It aims to ensure consistency, transparency, and comparability. It applies to most UK charities preparing accruals accounts, which you'll recall are mandatory for all charities with an income over £250,000 currently, but which could rise in October to £500,000. While the SORP is not legislation, compliance is effectively mandatory for charities required to prepare accounts under UK standards. So why has the SORP been updated? There are several reasons. There are increased expectations of transparency. There's greater focus on public benefit and impact, and lessons learned from regulatory reviews and sector issues, and alignment with wider changes in UK accounting standards. The emphasis under the new SORP is very much moving away from purely historical financial reporting towards explaining what the charity does, how it manages risk and resources, and whether it is financially sustainable. So when does the new charity SORP come in? It was released on the 31st of October 2025, and it applies to all charity accounting periods beginning on or after the 1st of January 2026. And it replaces the 2019 SORP primarily to align with the updated FRS 102 accounting standard. So what are the key areas of change? So one of the first areas of change is the new tier system, and I'm going to explain that in a little more detail later on. The second key area of change in the SORP is the trustees' annual report. There is now greater focus on strategic objectives, achievements and impact, key risks and uncertainties, and the reserves policy and the justification for that policy. The third key area of change is around the financial statements themselves. There are changes to income recognition, especially grants and contracts. There are new rules on lease accounting, changes to fund accounting and fund transfers, and disclosure of restricted funds. There is increased emphasis on clarity and narrative explanation. And then the fourth key area of change is a concept known as proportionality. Under this concept, smaller charities are not expected to produce the same level of detail as large national organisations. However, all charities must attempt to be clear, honest, and consistent in their financial reporting. Trustees should be confident that their reporting tells the charity's story clearly and would make sense to an informed but non-technical reader. Let's have a look now at the Charities SORP in some further detail. It's a very lengthy document. It has 29 modules and 2 appendices. Not all of those modules and appendices will be relevant to all charities. And in fact, I think most of those will not be relevant to most charities. So I'm going to concentrate on the key modules that I think will impact the majority of charities. At the start of the Charities SORP is a section entitled Scope and Application. And the SORP believes that there are limited changes in the scope and application of the SORP. However, the reporting requirements in the new SORP are now split between 3 tiers based on the charity's level of income. There is a new section included in this module to explain the criteria for each tier, how to report under the new tiering structure, and the interaction between the tiers in the SORP and the Companies Act thresholds. So let's have a look at the new tier system in some detail. Tier 1 under the SORP applies to all charities applying the accruals accounts concept and with an income of not more than £500,000. Tier 2 applies to all charities with gross income falling above the Tier 1 threshold and with a gross income of not more than 15 million. And Tier 3 applies to all charities with a gross income falling above the Tier 2 threshold. Now, before we progress slightly further into the new tier system, a further concept we have to understand is the activity basis. So activity-based reporting means allocating costs to specific charitable activities, for example, education, grant making, or support services. And under the activity basis, the idea is to show how the resources are used to further the charity's aims. So why is this important? Under the tiers, charities in Tier 1 may choose a natural classification or an activity basis of cost allocation. Charities in Tiers 2 and 3 must prepare their accounts on an activity basis. And this, I think, will see some quite significant changes to how accounts are presented because of the way costs must now be allocated to the various activities. Excuse me. So under the new tier system, there are various other reporting requirements. Charities in Tier 1 must obviously comply with the requirements of Tier 1. Charities in Tier 2 must prepare their accounts on an activity basis and comply with the requirements of both Tier 1 and Tier 2. And charities in Tier 3 must prepare their accounts on an activity basis and also comply with the requirements for Tier 1, Tier 2 and Tier 3 in respect of any other reporting requirements. So still on the tier system, a charity must assess their tier each year based on their annual gross income only. It should be noted that the additional criteria for determining or defining a small company under the Companies Act, in other words, employee numbers and total assets, are not considered in determining the threshold of the SORP tiers. Therefore, charities in Tiers 1 and 2 will need to also consider if they meet the other small company criteria to determine if they are exempt from audit and the certain reporting requirements as permitted by FRS 102. It would have been very sensible of the regulators to align the tier system with either the Charities Act thresholds or the Companies Act thresholds, but they didn't. So effectively, each charity now has 3 different thresholds to consider: the Charities Act thresholds, the Companies Act thresholds, and the tier system thresholds under the Charities SORP. So threshold monitoring is going to be very important as well as quite complicated. So I mentioned at the start that there were 29 different modules. So I'll turn to some of the more significant modules and the main changes that are coming through in those modules. Module 1 is about the trustees' annual report, and there are significant changes. This module includes new and enhanced disclosure requirements, plus changes to the structure of the module. The new requirements include reporting on how a charity is responding to and managing environmental, governance and social matters. Impact reporting is now a must for all charities. And in addition, charities in Tier 2 and Tier 3 should provide more narrative on how legacies are recognised in the accounts. So I thought I would do a little example of the sort of impact that Module 1 might have on the trustees' annual report. So this is an example of perhaps what used to be disclosed versus what the SORP compliant disclosure may look like. So previously, many charities would have said something like the charity continued its activities during the year, whereas under the SORP, now the disclosure is much fuller and would read something like, during the year, the charity supported 1,200 beneficiaries through its advice service, exceeding its target by 15%. Demand increased significantly due to cost of living pressures. So you'll see there's much more explanation in the trustees' report than there was previously. So key lessons of Module 1 and its impact on the trustees' report are trustees are expected to explain in detail what has changed, what was achieved, and why it matters. So let's move on to the next key module, which is Module 3. And Module 3 is about accounting standards, policies, concepts, and principles. Again, there are significant changes in this module from the previous SORP. More guidance has been included on the going concern basis of preparation, which very often is a significant challenge for charities, especially those that are reliant on primarily voluntary contributions. So in terms of accounting policies, an example of the sort of impact that Module 3 is going to have is this. So traditionally, we may have had a reserves policy that said something like the trustees aim to hold reserves of 3 months' expenditure. So the disclosure that would now be required under the new Charities SORP would be something like the trustees have set a reserves target of £250,000, equivalent to 3 months' core operating costs. This level reflects reliance on short-term grant funding and provides protection against delays in contract renewals. So again, it's much more detailed and more disclosure. So key lessons for charity trustees in terms of the accounting policy notes. Reserves policies must be justified and not generic. The next key module where there are significant changes is Module 5. And this is around the recognition of income, including legacies, grants, and contract income. And the changes here are significant. Now, FRS 105 has been brought into line with various international standards and has adopted a new 5-step income recognition model. That income recognition model has been brought into Module 5 and therefore now forms part of the new Charities SORP. So the 5-step income recognition model is as follows. Step 1 is to identify the contracts with the customer. And obviously the language here is more in keeping with a commercial organisation than a charity. So you'll just have to bear with me when I talk about customers and contracts. So step 1, identify the contract or contracts with a customer. The agreement must have commercial substance, approved terms, and clear payment terms. Step 2 is identify the performance obligations in the contract. Distinct goods or services promised in the contract must be separated. Step 3 is determine the transaction price. the amount of consideration expected to be entitled to, excluding third-party amounts such as VAT and including variable considerations, is the transaction price. Step 4 is the allocation of the transaction price to the performance obligations. So the total price is allocated to each separate performance obligation, usually based on standalone selling prices. And finally, step 5 is recognise revenue when or as the entity satisfies a performance obligation. Here, revenue is recorded as control passes to the customer either over time or at a specific point in time. And I think this 5-step model, being based on commercial transactions, is quite difficult to apply in a charity situation, especially where the charity is primarily reliant on voluntary contributions. And I think the difficulties where we have a charity like that is step 2, what are the performance obligations if someone just makes a voluntary donation? And step 5 is, when do you recognise that income, because when have you performed the performance obligation? So I think there are some real challenges in this 5-step module. Contract income is a bit more different because usually in a contract there will be various performance benchmarks. So for example, you may have to deliver a certain number of counselling sessions, and clearly when you've achieved that benchmark you can recognise the associated revenue. Voluntary income, I think, has some real challenges with the 5-step model, and it'll be very interesting to see how charities grasp with the challenges of the 5-step model. Okay, next one is module 7, which is the recognition of expenses. And again, this I think could be quite difficult to see how this plays out in practice, because the under a fundamental accounting concept is known as matching, where you're matching expenses with income. So the recognition of income under that 5-step model will drive the recognition of expenses, and that's perhaps a different concept to the way that most charities have considered how they recognise expenses in the past. The next key module is module 10. Module 10 is about the balance sheet. There are significant accounting changes here, primarily around lease accounting, and there is a whole new module just devoted to lease accounting. So I'll talk about that in a second. Module 10A is about provisions, contingent liabilities, and contingent assets. Excuse me. This module was covered as part of module 7 in the previous SORP, and the new module gives accounts preparers a clearer understanding of the meaning of provisions, contingent assets, and contingent liabilities. Not many charities have contingent assets or contingent liabilities, but it is quite often that charities need to make a provision, and therefore understanding the conditions that need to be satisfied to make a provision are important. The next module with changes is the new module 10B, which is about lease accounting. And this brings the charity SORP into alignment with some changes to FRS 102. So the new FRS 102 lease accounting rules, which were effective for periods beginning on or after the 1st of January 2026, align with IFRS 16 by removing the distinction between operating and finance leases for lessees. Most leases now require on-balance sheet recognition as a right of use asset and a corresponding lease liabilities. Key changes and implications include bringing an asset onto the balance sheet, increasing reported assets and liabilities. Exemptions: short-term leases, 12 months or less, and low-value assets, for example, laptops and phones, are exempt, allowing continued off-balance sheet treatment. The lease liability is measured at the present value of future lease payments, with the right of use asset typically equal to this amount. And in the profit and loss account, or the SOFA for charities, instead of operating lease rentals, expenses are recognised as depreciation on the right of use asset and interest on the lease liability. Now, I think this module is going to have very great impact on charities, particularly those that rent property, for example. That will likely be quite a large number under the new right of use asset, and equally a liability. The calculations are complex, and this is an area that I would urge all trustees to turn their attention to early on, and try and identify significant leases that may fall to be treated as a balance sheet item now under the new lease accounting rules. Module 14 is the next one. Module 14 is all about the statement of cash flows. Again, there are significant changes in the new Charities SORP, and to help smaller charities, the requirement of the previous SORP for charities with income over 500,000 to produce a cash flow statement has been changed. The SORP increases the income threshold to produce a cash flow statement to 15 million. So that means that really only charities in tier 3 are required by the SORP to produce. However, it's not necessarily that simple, because charities in tiers 1 and 2 are required by FRS 102 to produce a statement of cash flows where they do not meet the definition of a small entity under FRS 102. So hopefully some good news there. I think actually a lot of charities will be exempt from producing a cash flow statement. So those are the key modules that are changing, and some of the important aspects of the new regulations in the Charities SORP. But overarching all of those changes is still this concept of proportionality. And a small charity may worry that it must replicate the reporting of a national charity, but it doesn't. The SORP explicitly allows proportionality. And what matters is clarity, honesty, and relevance. And a good question for trustees to ask is, would this make sense to a reasonable reader? So you'll be pleased to know that we're coming towards the end of the detailed presentation. And I thought it would be handy just to try and summarise a few key questions for trustees. The first is, have we got the correct assurance regime? And that's why I spent some time going through the different thresholds under the Charities Act and the Companies Act. Are we monitoring those thresholds? Are our reserves and risks clearly explained? And are the accounts understandable to non-accountants? So in conclusion, my key messages are: thresholds are changing, but responsibilities remain. The new SORP raises expectations around narrative and governance, and early planning avoids surprises. Some of my suggested next steps are to review the thresholds at least annually, brief the trustees, and speak to auditors and independent examiners early. I hope you found that useful, and I hope I've managed to highlight some of the key aspects of the new Charities SORP and the challenges therein. So thank you very much for listening, and I hope you found that useful and informative. So I'll hand back to Jenny now.
Thank you, Phil. That was really, really helpful. I found it really, really useful. Hopefully everybody else did too. Now, if anybody has got any questions, if they'd like to add them to the chat, and then we can ask Phil them. And while I give you all a chance to type any questions you've got, I've actually got one for you, Phil. So I just wondered, as you're an auditor, what areas of the new SORP do you think are going to most increase audit work that you have to carry out?
I think it's going to be really in two areas, Jenny. The first is that lease accounting is new, and the calculations around the right of use asset are quite complicated and quite involved. There are also some complex transitional provisions. So I think that arriving at what value to put on the balance sheet as the asset, what to put on the balance sheet as the liability, over what period those are going to be amortized, at what interest rates that they're going to be capitalized, that they're all quite challenging questions. And I think from experience that I would urge trustees to start looking at significant leases fairly early on. And then the second challenging area, again, for auditors will be this 5-step revenue recognition model and how the charity complies with that. As I said in my presentation, I think that if you have a contract and contractual income, that model becomes less difficult to apply. If you have voluntary income, it becomes much more difficult, because with voluntary income, what are the performance obligations and when are they satisfied, and therefore when do you recognise that as income?
Great, thank you very much. So we've had a couple of questions now. So the first one is from Rachel from CIO. So they're incorporated. I assume we are required to complete accrual accounting.
I would imagine so, yes.
Okay. And then the next question is just to confirm, if our financial year ends on 31st of March 2026, we won't be affected by the new statement. This means the changes will first apply to accounts prepared to 2027.
Yes, that's correct.
Thank you very much. And another. So most operating leases will need to appear on the balance sheet with both a right of use asset and a corresponding liability. From the new financial year, we will need to recognise most operating leases on the balance sheet under the revised FRS 102. I think that'd be under SORP. This is expected to increase liabilities and change how lease-related costs are presented in SOFA. We will also be arranging a meeting with the auditors to obtain guidance on this approach and required disclosures. So I'm not sure, is the question for Phil there? If you could just clarify that for me, please, Pam.
Yes, that is correct. The statement that they've just made there is correct. There is a fundamental change in the treatment of leases. So historically, operating leases have simply been expensed to the SOFA, whereas now trustees have to look at the lease. This only applies to significant leases. If low value leases, such as, for example, a photocopier, you wouldn't follow this process. But you have to look at the future value of the lease payments and discount those back to their net present value and put that figure on the balance sheet as the right of use. Now, of course, the first thing you've got to do is establish, well, what are the future lease payments? So that means getting the lease out, and very often that can be a challenge. But then the real difficulty is, well, what's the interest rate that you use to discount them back to the net present value? And with practical experience that we've had of implementing this new requirement, both under FRS 102 and the Charities SORP, that's a difficult question. But of course, it has a significant impact on the end value that you arrive at. And then what happens is that as you make the lease payments, they are deducted from the liability that you now have on the balance sheet, rather than going to the SOFA. And then the effective interest in the lease is expensed to the SOFA. So it's a very different treatment.
A couple more questions. So we've got one that says, in example 1, so I think this is back when you was giving examples of the audit thresholds. In example 1, it says that we used to get audited, but income was 800,000. I thought the limit was 1 million.
It is. That is correct.
I think in example you was giving ability.
Exactly. Yes. The threshold is 1 million. Their income was 800,000, but they were having an audit.
Even though there was no legal requirement, there was
no need for one. But what had happened, and in fact that example was based on a real life example of a charity that came to us last year, where historically they'd had an audit. Over time, the thresholds had changed, and they'd retained the audit when actually they didn't need to. And when they came to us, I said to them, why are you having an audit? Because it's expensive. You're a relatively small charity. It's a big cost. Why are you having one? You don't need one. So they then went to an independent examination. So the point is that in history, charities may have had an audit when thresholds were lower, and that regime has continued when actually they don't need to.
Great, thank you very much for that. We have got one more question here. When you say contractual income, would this also include grant income, where it is for a specific activity and has its own budget and KPIs, etc.? Right.
Yes. It's where there are defined deliverables. So someone's made you a grant, and as part of the grant conditions, you have to deliver certain things.
Okay. So one of it, is there a specific value of low value as opposed to high value for leases? For example, a photocopier of £3,000 a year, is that high value?
No, there is no, in neither FRS 102 or the Charity SORP, they don't define low value. So I think really it's down to, in the context of your own charity's accounts, what do you consider to be low value? And a low value item in a charity with income of 15 million might be very different to a charity with an income of 1 million. But there is no formal definition of what low value is.
That'd make life too easy, wouldn't it?
Yeah, it would. That'd be too simple.
And then another question, am I correct to believe that property leases must be recognised as right of use asset and lease liability?
I would think in most charities, a property lease would not be a low value lease because of the amounts of money involved, and therefore you would put it on the balance sheet as right of use asset and also have a corresponding liability. Just as a side issue, which people may not have considered, this right of use asset sits on the charity's balance sheet as an intangible asset. So for the first time, many charities are going to have an intangible asset on their balance sheet of some magnitude. And I can see some interesting questions coming up at annual general meetings.
Right. So then just having a quick look in the Q&A. Somebody's asked about what FRS means. So FRS is the financial reporting standards. So that's what all companies have to prepare accounts to.
Yeah.
I think that's all of the questions have been covered now. Oh, so would a building lease, which is already recognised and depreciated, need to have any change in recognition?
It depends. I suspect that what might be on the balance sheet at the moment is not the lease itself, but perhaps expenditure that you've incurred on the building, very commonly called leasehold improvements. So that's what might be on the balance sheet currently. In addition, the charity would need to bring onto the balance sheet the right of use of the lease itself.
Great. Well, I think that's answered pretty much all of the questions that we've got from the chat.
Fantastic.
And the Q&A, which is brilliant. So thank you so much for your time, Phil, on answering those questions. And just to reiterate to everybody that we'll be sending out a copy of the slides, which of course could be useful to share with your trustees or other members of staff. We are recording this as well, so we'll make sure that that is shared on our socials. It'll also be added to our YouTube channel. We have other sort of learn and share sessions on our YouTube channel, so you please feel free to check those out. And I'll give a little shout out to our next upcoming learn and share, which will in May. We're going to be focusing on how you can look at preventing fraud for small charities. If you've got any questions about what we've covered today, and if you'd like to have a chat with Phil and possibly look at if you need to go down an option of getting in an auditor such as Harris & Co, I'm sure they'll be more than happy to have a chat with you about that. So thanks very much for taking the time to join us today, and I hope you have a great rest of your week.
Thank you, everybody. Thank you very much, Phil.
Thank you, everyone. Thank you.